Mhm.
Jared, can you please bring move Mr. Fernandez back to the attendee room, and if you could move Greg Ruiz and Mario Giannini into the presenters room, and maybe Ben, do you want to briefly introduce the session while Jared's going through that?
Yes, I'll be happy to. Thank you, Dan. Thank you for joining us, Henry and Dan. And now we have another set of special guests, with Hamilton Lane, the CEO, Mario Giannini, joining our Managing Investment Director of Private Equity, Greg Ruiz, to discuss the evolution of the private equity industry and some of the lessons that have been learned along the way. And following this session, we'll break for lunch. So Greg, over to you if you are ready.
Yes, I am. Thank you, Ben. Well, it's my pleasure today to have Mario Giannini with us, who has been mentioned, is CEO of Hamilton Lane. I thought I would start just by giving a brief overview of Hamilton Lane. I know a number of our board members are very familiar with this institution. But I thought it would be helpful for all of us to start on the same page. So just a little background on Hamilton Lane. They are an active participant in the alternative investment space. They have very broad activity across the private markets. They deploy capital across multiple strategies, including primary investments and funds, secondary investments and funds, direct and co-investments, as well as investments in opportunistic funds. As of March 31st, Hamilton Lane had $434 billion in assets under administration, with about half of that related to public pension funds. In total, Hamilton Lane has over 500 clients, which are diversified by type, size, and geography. And they have clients in the US, Europe, Middle East, Asia, Australia, and Latin America. Hamilton Lane was established in 1991. And Mario joined shortly thereafter. He became CEO almost 20 years ago. So Mario, just to kick us off, I'd like to start by asking a few foundational questions to ground us in a common understanding of certain elements of private equity. So could you maybe start us just by giving an explanation at a high level of what private equity is?
Sure. Can everyone hear me? Okay, good. Yeah, private equity is basically, it's public equity, but private. I mean, I know that sounds stupid, but it is essentially buying an interest or extending credit to a company that isn't public. There are variations on that, but that is its core definition. It is basically having some way of financing or providing capital to a privately held company. And there are variations on how much control you have or don't have in a company, but that's what it is at its core. There's nothing mysterious or magical about it.
And could you walk us through how a private equity fund works?
Sure. This is one of the things, when you think about how private equity has changed in 30 years, this is one of the things that has not changed. And it starts with you, the limited partner, and you make a commitment to a fund. And that is how the industry started. And what's important about that, we'll talk a little bit about why that has some good and bad characteristics. But unlike in public equity, where you give someone $1 and they invest it right away, or you give it to them and they do what they want with it, in the private equity world, you sign up to commit $1, and it's called over time as the underlying general partner invests in companies. And so there's this constant stream of cash going back and forth. You fund when they buy a company, and then when they sell it, they give it back to you. That is, in its basic element, how private equity works. The good news about that is it keeps investors from doing what investors always do when they make mistakes. They want to pull out of the market when it's going down. You can't. You have committed the money and you're in the fund. And I know people sometimes view that as bad, but that's really good because it does prevent you from making the usual mistake. The bad part from many investors' perspective is you are paying fees on that full dollar that you've committed, even though it's not all invested. And so that is part of the cost benefit analysis you run as you look at it. But that's the essential structure that has been that way for, as I said, roughly 30 years.
And Mar, I think you were starting to hit on this, but could you walk us through just the basic economics of a private equity fund?
Sure. The economics are there's a management fee, and it can be anywhere from 1% to 2.5%. Usually the larger funds are at the lower part of that scale, and the smaller funds or venture funds are at the larger part of that scale. It is normally paid, as I said, on the commitment during the time managers are investing, and then it flips to invested capital. And that's the fee part of it. In addition, there is usually a profit participation, what's called in our industry a carried interest, which is generally 20% of the profit. What is important in the private equity world is that is not paid on valuation. It is only paid when money is returned back to limited partners. So there's no playing around with valuation the way there are in some other asset classes where the valuation makes a difference on how much the manager gets paid. In the private equity world, it really doesn't. The money only is returned, that 20% only goes to the general partner when they have liquidated an investment at a profit.
And we know as LPs like CalPERS, we put substantial capital at risk with our private equity managers. Do the private equity managers themselves, or general partners as we typically call them, do they typically have capital at risk in their funds?
Yes, and that's one of the biggest changes really forced by limited partners in the asset class over 30 years. It used to be, and it is with many general partners, particularly the ones starting out, they put up 1%. So, for $100, they put in $1. Now what you see is a lot of managers are putting in much more than that. And so it is not uncommon to see managers putting up to 5, some cases 10% of their own capital into transactions. And for many investors, that's a good thing because it shows you're aligned. They have their own money at risk. And so people view that as a positive development in terms of how the asset class has grown over the years.
Mario, I mentioned earlier, I know you started at Hamilton Lane in the early 90s and have been CEO there for nearly 20 years. I'm interested in your feedback in how the private equity industry itself has evolved over that period of time.
Yeah, I think there are a couple of things. As I said at the outset, what hasn't changed is the basic structure. And I don't know that will change anytime soon. The way the industry operates has changed. Let me divide it into two pieces because it is important. Private equity started really as a venture capital business. That's who started it back in the 70s, essentially. And venture capital, by that I mean you're investing in small, almost in some cases unknown and unproven companies. That is one piece of the industry. What gets much more attention and publicity, largely bad, is the buyout part. And that has changed dramatically, but its reputation has not. So when the industry first started on the buyout side, it was largely a question of you put in as little equity as you can and you lever the company. You borrow as much as you can. That was really the genesis of the industry in the 80s. You could do that then. It's like buying a house and putting no money down. And so you win if the house value goes up, and if it doesn't, fine, you walk away. I mean, think of this industry that it's the prototype for what it was called is barbarians at the gate. So it gives you some sense of how the industry was viewed in its early days. You don't want to be the barbarian. Like, that's not a good thing for an industry. But frankly, given the profile of what they were doing, there was every reason to think that was the case. That has really changed quite a bit, although, as I said, I'm not sure the reputation the industry has changed. It's still fixed in that era of a group that comes in, levers a company, strips it, makes money, walks away. What you see now, and this is one of the big changes in the industry, is it's more about operations. It's more about taking a company and turning it into a better company. It's more about growth. And that's really been forced on the industry by its own growth. It used to be you could buy a company cheap, lever it, do what you wanted to do. That's just not the case anymore. You really have to buy a company and have a plan for growing it. It's just not a situation where you can just use leverage. It's also, and I think this is important, been forced on the industry by you, the limited partners. Remember, again, in the 80s, there were a lot of hostile takeovers that private equity was involved in. You just don't see that anymore because I think limited partners are saying, no, we know how this should work, and it should work with growth. It should work with operational improvements and not be involved in hostile acts and doing the things that the industry had done many years ago. So that has been a real evolution. Venture has largely stayed the same, but of course it never had the reputational issues that the buyout world had from the early days.
Yeah. And from the infancy of the industry in the 80s until now, there's been a significant growth in assets. And I think it's fair to say the importance of the industry has grown. And I'm interested in your take on the implications of private equity's growing prominence and scale for various stakeholders, LPs, but also employees, companies, and other groups impacted by the owners.
Yeah, I think, in obviously I'm in private equity, so it's supposed to be perfect and everything's wonderful, but I think this is a place where the industry over the last couple of years has begun to grow and I think realize that it is no longer a small part of the world. It is now, I remember in the early days, you used to sit in front of boards and have to explain why private equity, why would anyone invest in this? Now the question is not why, it is how much, how does it fit in my portfolio? And as a result, the asset class is now part of every discussion of corporate finance in the world. And it needs to mature, and it is maturing because you now have an industry that is a major employer, again, around the world. It is a major part of capital markets around the world. And it's not huge, it's not 50%, it's none of those numbers, but it is a significant piece of economic life. And that is very different. And so the responsibilities, I think, for us, for general partners, for limited partners is greater. And you see that developing, you see those discussions going on, you see that kind of dialogue that you sort of didn't see 15 years ago. It was just kind of a backwater and people didn't worry about it.
I'd like to shift focus a little bit here and move into a discussion of lessons learned over time in the industry. We've seen, over the last 20 years now, a number of significant downturns. And I'm interested from your vantage point, what are the lessons you believe that LPs have learned from those prior downturns?
Well, it's interesting because given the downturn, particularly in March, I mean, obviously markets have recovered. I think investors, limited partners, learned a huge amount from 2001, and particularly 2009. In 2009, you would be having, I can remember phone calls and discussions in front of boards where people simply wanted to get out of anything illiquid. They just wanted out. Like, I don't want to hear about it. I don't want to talk about it. Just get me out. And it proved to be a wrong decision in both market cycles. And now in this one, even in March, at the worst part of the market, what I think many investors learned was consistency is important. That private markets tend to do better when markets are in upheaval. And whether I commit more or not is not really the question, but I can't step away and completely change my investment approach the way many did in 2001 and in 2009. And I think that is part of the learning. That is part of the experience. That is part of knowing how the private markets work, particularly private equity. So that has been a huge change, and that's global. That's not just in the United States. I think you see that in virtually every region, because I'll throw this in. The other big change in the last 20 years is how much more global the asset class is. that it's not just, it really was a US dominated with some European. Now it is, I think something like 40% of the industry is non-US, which is way up from what it was just a few years ago. So all LPs globally have kind of figured out that consistency does matter.
Mario, I want to get into a couple more of these themes, but I saw a couple notes on questions from our board. So, Mr. Jones, I wanted to flag that for you and see if you'd like to have those now. We certainly would welcome them, or if you'd like to hold off.
No, we could go ahead. I was waiting for you to take a break. And so we have Ms. Taylor.
Thank you, Mr. Ruiz. Mario, I have two questions. So one is, and you brought up the way the private equity used to be, barbarians at the gate, which I had forgotten that was the name for it, but yeah. And that it has improved, but I would like to, I'm hearing a lot of rumbling in the market. Like you said, it's usually the press that hits, is the buyouts, the, leveraging, et cetera. How do you see private equity moving into the 21st century, keeping in mind that it is such a large market share now, that it touches people's lives, whether they're workers, whether they, shop at a supermarket that's owned by private equity. So how do you see improvements being made so that we're not seeing that kind of negative press? And that's my first question.
Well, on the negative press, I don't know that will change all that much. I think it is an easy industry to take shots at because many of the more visible figures in the industry are enormously wealthy. And so they make a great target. So I don't know that will change anytime soon. I think, though, that you do see the change in terms of what private equity practitioners react to. So ESG kinds of matters. Again, that 10 years ago were not really at the forefront. And if you look at it now, they are part of every conversation, some more than others in terms of the E or the S or the G. Some groups more than others. I would say the larger groups that get more of the bad publicity are actually, I would say, more along the curve in terms of doing things that hopefully are better citizens. So I think it is a part of the industry that continues to evolve and will get better. I will say, though, at the risk of being somewhat controversial, some of the things that private equity gets tagged for are things that, so for example, I know there's a lot of discussion about private equity involved in the healthcare sector and whether that is appropriate. My comment on that would be that I think that's a bigger discussion than just private equity. Whether private equity or a public company are making money in a profit-making way in the healthcare sector is one thing. But I think some of the discussions where private equity is taken to task are really more around the nature of, do we want healthcare in certain areas to be owned privately or public? Do we want it to be more of a public ownership? So I do think private equity gets tagged with some of this in a way that public companies are doing very similar things. But again, I say that knowing that because private equity is becoming more important, I think this is on virtually every manager's radar screen now. And while I don't like the bad publicity, the good news about the bad publicity is it really makes the general partners think about that next deal they're going to do and how it impacts people from a social perspective, a governance perspective, an environmental perspective. So I think this is an ongoing part of the industry's development.
So you do see then ESG becoming more integrated into private equity?
Yeah.
Okay. So,
yeah. What's interesting, and I'll take a shot at US LPs. We have LPs from around the world, and in some countries, the Nordics, Australia, New Zealand, ESG is almost the number one criteria for investing in everything, leave aside whether it's public or private, but in everything. That is not the case as strongly in the US. And so I think if you're a general partner, That's why I think some of the big ones are more sensitive to this and have a more robust process because they have investors from all over the world. And so they hear it from a bigger set of groups than just investors from one country.
That makes sense. I appreciate that. I think that as we see some of this come out in the news, and you spoke specifically about the healthcare industry, and yes, that's a huge discussion. I think we can all agree on that. But I just want to make sure that we're adhering to whatever risks and opportunities that private equity gives us. And then my second question is, given that private equity, we're going to be announcing our returns this week, and I know that PE valuations lag a quarter. What do you think we should anticipate seeing in our PE performance, and how would you advise investors like us about the future of PE in this environment?
I think the March quarter, the valuations, I mean, what we're seeing is, it depends on the exact construct of your portfolio, but it's probably going to be down 8 to 10%, roughly, somewhere in there. Again, it will depend on what exactly your portfolio, whether it's got more large buyout, more growth. If it's got more growth, it'll be on the lower end. If it's got more large buyout, it'll be a higher end. And then in the June quarter, I suspect it will be up. It's really too soon to know, but given the public markets were up and operating performance, as we hear it, was surprisingly okay at many portfolio companies. I'd be surprised if it wasn't up some amount, but not sure how. In terms of what private equity will do going forward, you know, that my compliance people don't let me give predictions of future performance. And they're right, I shouldn't. But if you look historically, part of it depends on what you think the public markets are going to do. If you look historically at how private equity has performed, it has tended to do best in periods of flat to slightly up or slightly down markets. I mean, that's really its sweet spot. When markets are going up 10, 15% a year, private equity will struggle to keep up performance. I mean, that's what the data shows. So again, in periods of dislocation, private equity has tended to do better. And if this is a period of dislocation, and I assume it is, even though the public markets are doing reasonably well, then I would expect that private equity will do what it's done traditionally.
Okay, thank you very much.
Okay, Mr. Miller?
Thank you. Yeah, very much enjoying all the presentations, and this one in particular, I appreciate that you answered quite a bit of the questions I had and the concerns I wanted to express when speaking with Ms. Taylor. But I guess I see the evolution of this market. I see the just the burgeoning growth and how important private equity is going to be in the broader marketplace and in our future. But while I still don't view the industry as just, you know, using financial engineering to pillage everything, we still see examples that that give us pause when it comes to our CalPERS values, especially related to, as we talked about quite a bit earlier, the human capital element. And so I'd like to get your thoughts on how do we help the industry get better in terms of being able to match up with our values, so we don't see private equity efforts to make operational improvements to the detriment of the human capital of the firms, which in the long term isn't going to either match up with our values or give us the kind of returns we want. So, for example, you know, moving a firm into a state where they can basically break the unions, move them, changing those kind of terms, and basically improving performance on the backs of the employees is something that I very much worry about. And so how do we bring those kind of values to the fore in dealing with private equity?
Well, I think there are a couple ways. One of the ways is, I mean, there is the ILPA, the Limited Partners Association. I think one of the things that, from a general partner's perspective, as I mentioned in a couple of contexts, is what do their investors want? What do they want from them? What do they expect from them? Because again, for all the talk, I mean, they need to raise capital, and they need to raise it from people like you who give them the capital. And every investor has certain things that are very important to them. So I think from an LP perspective, it's always easy to focus on the general partner and say, you general partner, do this or that. But I think limited partners need to coalesce a little bit around what does matter to us. As I said at the beginning, like the Nordic countries, for example, you just can't raise capital in the Nordic countries if you're not particularly environmentally sensitive. You just can't. So I think part of your effort needs to be around other limited partners. The other part needs to be around making this very clear to general partners with whom you work that this is a critical matter, and it will impact your willingness to engage in future deals with them, transactions, future commitments. Because here is where part of your strategy needs to be. You need to be focusing on a certain number of general partners with whom you have a strategic relationship. And that strategic relationship needs to be more than you just give them money and they just send you money back, because you do have things that you view as important for return and important for risk. And that is part of what I think general partners need to understand, is that doing things that raise the risk profile of both their ability to get capital, but also the company's ability in this environment to thrive, because nobody wants to be associated with a company that's laying off people or mistreating employees. I think that's the kind of thing that you are seeing more of. I totally acknowledge that there are situations where you look at what private equity has done and you go, oh my God, what the hell were they thinking? But I do think it's less and less, and I think it's because of efforts by investors like you to push that kind of change.
Great, thank you. Appreciate the advice.
Okay,
Hey, Mario, just one sec, Mario. I just wanted to actually even expand a little on Mr. Miller's question. From your vantage point, you see hundreds, thousands of private equity firms. And my question would be, do you view private equity ownership as synonymous with job loss?
No, I mean, look, this becomes a political debate. I've seen the statistics on both sides. But I can tell you that most of the firms that you invest with, that are high-grade institutional quality firms, that's not how they create return anymore. Again, it may have been in the 80s. It just isn't, for a number of reasons. Remember, if you're selling your company to a private equity firm, and that firm has a reputation for ripping companies apart, for getting rid of employees, there's a lot of competition for your company. You're not going to sell it to somebody who has that reputation. You're just not, for competitive reasons, for your employee reasons. So I think that when you look at where most growth, and we have value attribution models that say, how do people get return in private equity? At this point in private equity's history, most of that return is coming from growth. It's not coming from cost cutting. There is financial engineering. I'm not going to sit here and say, oh, no, they don't do financial engineering. Around 20% of return comes from their ability to do things with balance sheets. So I think that is, it's a growth industry at this point, some more than others. Again, it's not every company's growing 20% a year, but that's how they're looking to grow.
Okay, Greg? Okay, Ms. Yee.
Thank you, Mr. President, and thank you, Mario, for the presentation. I guess just apropos of the morning session on human capital management and some of the questions of my colleagues, there does seem to be, I think, a little bit more resonance with respect to PE firms and portfolio companies in the private space, leaning in on issues like diversity without expressly stating that. Is that a trend that you're seeing? And what other areas are you seeing more of that alignment of interest happening on the natural?
Yeah, I mean, look, diversity was an issue before, and with the Black Lives Matter protests, it's just a huge issue now. And this is an industry, too many people look like me, and there is no question that that needs to change. Again, I would say some of the larger firms have been very aggressive in promoting that change. You see things, and I mean, we do it, they do it. You see things in hiring, you see things in mentoring. One of the things that I think we all recognize is nobody wants to work in PE. If you're a young professional, PE is not where you want to go. Nobody looks like you. It's got a terrible reputation. So I think part of what the industry is trying to do is mentor people, bring them in as interns at an earlier age to show that this is a place that it's fun to work at, you can do well. So I think diversity across a number of different factors is a real area of focus for the private equity industry. Again, part of it because of both the opportunity and the risk. I think there's a general recognition that if you're not a diverse firm, there's a risk crassly in being able to raise money because groups like you look and go, well, yeah, you don't even care. Why? I'm not going to, I have other choices. But there's also a risk in recruiting. I think that what general partners recognize is that a diverse firm is a better place for people to work. And so they're very conscious now of making that more front and center.
Okay. Okay, Mr. Rubalcaba.
Thank you, Mr. Jones. And thank you, Greg, for picking Mario to speak. Sir, I really appreciate it's a robust discussion. I liked how you started with explaining how the economics work, and I was impressed by how you were able to explain how there has been an evolution in private equity to go to what you termed operational improvements, the growth, and what have you. But more importantly, you said that a lot of that change in focus has been because of the limited partners. And I appreciate how other people asked how to make that happen. And so that was my question, but I think people have answered it. But you also talked about there has to be like, in response to Mr. Miller, but there has to be a strategic relationship between the limited partners and how they coalesce. But how would you advise us? What should be the standards or the what due diligence is there available so we make sure that the private equity we pick for manager is responsive to the limited partner, is cognizant of the values of the investor? What would be your advice or response to that question? Thank you.
Well, I think that, and you probably have this, but certainly everyone has a questionnaire that they give a general partner, and it's normally give me the cash flows, give me everything that you've done with companies, give me your track record. I think having an ESG questionnaire is equally important, where then you can understand how does ESG fit into, and all parts of ESG, not just one, but the E, the S, and the G. How does that fit into your strategy? And then I think it's because talk is cheap. It's easy to say, I'm going to do this, I'm going to do that. I think then you measure. What we do, and I suspect what you do, is you look at, okay, last year, here are the metrics. Have they gotten better? If they got worse, why? And you have these conversations. I think that the general partners need to understand that, yes, investment return is critical, but that there are 3 or 4 other things that are also critical in terms of maintaining the relationship and in terms of having a healthy relationship. So those are they're not magical, they're not unknowable. There are things that can, you manage what you can measure. And so I think for us and for you, that is not a difficult task. It may be difficult in terms of assessing what you want to prioritize, but that's a different matter.
Okay. Ms. Brown?
Thank you.
Ms. Brown?
Thank you. I just had to unmute. Thank you. Mr. Giannini, I wanted to talk a little bit about the fees charged by general partners. You discussed that LPs typically get charged between 1% and 2% fees while we're waiting to invest our dollars. But I want to talk about sort of what I call the hidden fees. the fees that are charged to portfolio companies that that we don't necessarily see. I want to just have you give us a conversation about what type of fees are charged and what happens to those fees. I don't know if the rest of the board knows about the history of this and how a while ago GPs were, passing through invoices for consultants or legal, and they were getting it discounted but not charging it back to the portfolio company. So I just want to, and I keep hearing that GPs get caught charging a fee and the whole industry has to correct, and then they come up with the new way of charging another fee. And so what are those kinds of fees and what happens to those fees?
Broad question, so it depends. I would say this is one place where the SEC has been really good because, as you said, they found some enforcement. I think they had some enforcement actions. They certainly had a lot of settlements with private equity firms. It depends on the firm. Not all firms do it, but what a lot of firms will do is they will say, I am performing a service, therefore I will expect my portfolio company to pay it. I will tell you that it has always been pretty controversial among LPs. A lot of them just don't want that happening because at the end of the day, it's taking away from their return.
Yes.
What general partners typically did and still do is they will keep it as an offset against the management fee, which is good, except normally it's higher than the management fee, so it means a lot more money to the general partners. What you are seeing now, and again, this is not universal, but certainly with most of, I think, the general partners you deal with, most of the large ones, is at the advisory board, the limited partner advisory committee, they have to disclose all of the fees that they are charging to portfolio companies. And they obviously don't want to do that if it's egregious. And so you are seeing that come down. You are seeing a far lower number of fees that are being charged to portfolio companies and therefore going to the general partner. And certainly the amount of undisclosed fees, I would say, I'm not going to say that it doesn't exist, but it is down substantially as the SEC has begun to look at this. And there's sort of a real impact throughout the industry of, I don't want to be investigated by the SEC and charged with a fee that's not appropriate. So is it perfect? No. Is it really better? Yeah. And I would thank the SEC. I wouldn't thank the limited partners or almost anyone else.
Thank you.
Okay. Let's see. Ms. Taylor, you have a question for Greg, you said?
Yeah, just a quick question. Kind of Ramon's question, basically about, but instead of Mario, Greg, how are we as CalPERS, as a limited partner, in implementing the ESG strategy and our investment beliefs in our private equity? Mario did mention, your questionnaires that we have for, are we using those, or is that something we're using? I know this, when I first got on the board, they were talking about that we couldn't ask these kinds of questions because it would make them not want to invest with us. But it sounds like it's a much more accepted practice now. So I was wondering what we do.
Yeah. I think it's certainly an area where, as Mario hit on, that's developed meaningfully. And just to answer your question directly, we've been very active in incorporating an assessment of a manager's ESG practices into our own diligence. And so earlier, Mario hit on ILPA, which is an organization of limited partners. We're active participants in ILPA, and we actually worked with them to integrate ESG into their template. So that not only gives us as CalPERS insight into all our managers, but it actually has a broader impact on the industry because those templates are commonly used by many LPs. And so now you're seeing that reporting largely becoming a standard part of an LP's diligence process, even outside of our walls. So we've really, I think, pushed up the curve and highlighting that as a kind of a critical part of the diligence we do.
Excellent. I appreciate that. Thanks, Greg. Thank you both.
Yeah, just on that question that Teresa, I think Greg, your response on ILPA, Mario, recognizing that ILPA is probably now what in its fifth, sixth, seventh year in terms of organization trying to bring about change in the private equity industry. From your point of view, are there some things that are being recommended in ILPA that you disagree with? Or if not, are there some things that you do agree with, but the industry is not adhering to them? And if that's the case, what should be done to have a broader implications of all general partners?
It's hard because remember, for ILPA, you have, I don't know how many limited partners, and they all have different agendas. And so when I look at what ILPA is doing, it's not really a question of, do I agree or disagree? It's a question of, I'll take, for example, I think one of the things where private equity needs to do a much better job is transparency, reporting, data. And ILPA has done a great job about creating a standard template for reporting, which makes all the sense in the world. But what many limited partners, when you talk to general partners, what they tell you is there's the standard ILPA template, and then there's the CalPERS template, which is ILPA plus. There's the XYZ fund, which is ILPA plus. And so they basically are looking at what they had before, which is 100 different templates. It may be core around one. So I think that one of the issues in the industry is whether limited partners want to say, I don't want that or need that, because in the interest of making this more efficient and making it more transparent, here's what I'll do. It's tough. It's like herding cats in many ways. So I don't really have anything where I'd say ILPA's not doing it correctly. I think they've done an enormous amount of work in the last 10 years in making the industry more uniform. But it is very hard because a number of limited partners will say, yeah, I know what ILPA's doing, but I want that general partner in my portfolio, so I'm not going to demand that, or I'm not going to ask for that. It's difficult. I think it is doing as good a job as it can. I think for CalPERS, ILPA's one piece, talking to other similar investors of size and scale is another piece. I mean, there are a number of opportunities and ways to coalesce around it.
So what are your views on the question of whether or not there should be enabling legislation or regulations to require compliance?
Require compliance, it depends on what. I mean, I think that if you have compliance around certain reporting issues, things like that, it's probably fine. The issue with legislation around private equity is, as I said at the beginning, you have buyout, you have venture capital, you have such different kinds of ways they do business that it's probably hard to get one piece of legislation. But if legislation is, here are the 10 basic things you got to report, it's hard to argue.
Okay, thank you. Ms. Middleton?
Thank you, Mr. President. Mario, and thank you for a very good presentation. I was intrigued by a comment you made earlier regarding, if I understood it correctly, the difficulty that private equity has in matching the returns of the public market during a hot environment when the market is expanding and growing very much, which of course raises the question, to what extent should private equity be used to increase diversification and be a hedge against downturns in the market? And would like you to expand your views on that.
Well, I think, the interesting thing about private equity, so I'm going to say something that maybe you know it, but I always find people look at me like I have two heads. I think most people just don't, they get risk wrong in private equity. I think the risk of loss in a reasonably diversified buyout portfolio is minimal. Everyone always says to me, oh, I'm worried about private equity because I'm going to lose money. That's not the risk in private equity. The risk in private equity is what you alluded to, which is the upside capture. I don't think I don't think I've seen a portfolio that is buyout oriented that lost money in any market cycle. We've done studies that, you know, the worst 5 years in private equity is positive. There's no other asset class that does that. Private credit maybe, but so I think as you think about why that is in a big rising market, private equity people are reluctant to chase values. They're just reluctant to pay top dollar as the market's rising ahead. And a continually rising market doesn't give them the opportunity to do what they do best, which is buy at a good point and then sell at a reasonably good point above that. So I think it's just the nature of the way the asset class operates. But it's not to say, even the studies I see that are negative on private equity, what they say is it only matches the return. You know, that latest study said that from 2006 to now, it only matched the return. And that's average. So if you're telling me that in the best market environment on the public side, private equity's holding its own, and then in lousier market, it does much better, I think that's a trade-off I'll take rather than having the private equity people keep trying to chase that last deal to do at the market top. Did that make sense? Did I answer the question?
You did.
Okay. Sorry. I know sometimes I ramble and people look at me like, what was my question?
I'll be asking the same question of the folks from Wilshire later.
Okay.
Okay. Mario, could I just follow up? Could I follow up with one question, related question there? Mario, you alluded to upside capture, and also how some of these studies look at median returns. I'm interested in your feedback on how a scale investor like CalPERS or Hamilton Lane or other scale investors, I'm interested in your view on what levers are at our/their disposal to outperform the median returns of the industry.
Yeah, I think this is one place you have some advantages and some disadvantages. So the disadvantage of someone your size is, you know, like doing venture capital for you is really challenging. And that at times can be a great returning part of the portfolio. And so let's take that away. That's a lever you don't have. A lever you have, one is common sense. The single biggest mistake we see investors make, and it's why so many underperform, is consistency. They fall in love with the market when it's high, and then they get scared when it goes down, and so they want to get out. If you look at some of the great investors in private equity, and some are your peers, it's not, you know, I always hear public pension funds can't do well. They can, they have. They just kind of keep a steady pace. They don't go crazy one way or the other. The other advantage you have is, I go back to scale, you can reduce some of these fees. You can do things like co-investment, which gets the fees down. You can do some of the things where you're negotiating better fees. So there are a variety of things that investors can do. You kind of have to make your own assessment of what your risk tolerance is, what you want to do internally, what you want to outsource. I think those are the questions that become key. I would say one of the least, in my view, understood levers is matching up your goals and your governance and your resources with what you want to do. I think many times investors believe that their governance makes them fast and nimble and let's move in, let's move out, and they can't. So I think you really have to think long and hard about what can I do, what am I willing to do, and what opportunities does that give me. But an institution like CalPERS has huge levers to pull in this market.
Okay, Ms. Oliveris.
Thank you. Mr. Giannini, you commented earlier about trends you're seeing when it comes to diversity and inclusion and equity, and that some of the GPs are looking for that in the portfolio companies, or now when funds are out fundraising, they want to see diversity. In my experience, it's actually 10 times harder, at least, for people of color, women of color, to go out and raise money, even if we have outperformed our competition significantly. There's a discount factor applied in institutional racism, sexism, or whatever. How is Hamilton Lane committed to ensuring top performance by ensuring equity in its portfolio company? And by equity, I mean racial equity and gender equity.
how do we do it when we assess performance and assess whether to invest in
And
a
the
fund?
team, yes.
Yeah. No, I mean, that is, as I said, as part of our questionnaire process, as part of our, that is part of what we are looking at. And frankly, part of what we're trying to promote in terms of saying that this has not been an industry where it's been a level playing field. And we need to change that. And the only way you change it, I mean, I've said this all the time, the only way you change it is by backing people that have traditionally not had access and having them succeed, because then people see it and they go, oh, that works. It is a tremendously trend following asset class in the limited partner community. And as you begin to create success stories, it will move from there. But it's been slow. I don't think there's any question that it's been slow. But I do think, this is why I think that the last couple of months have marked a real change. I mean, as we have conversations with our clients, that is changing. It is now not just talk. It is not just lip service. It's, okay, what are we going to do? And let's pursue these opportunities.
How many women of color CEOs in your portfolio companies?
Oh, within the underlying general partners, I don't know the number offhand. I don't even know if I assume we have most of that data, but it's very small. It's it's not zero, but it's very small.
Can you give me a blanket percentage?
Oh gosh, I can't, but I'm willing to bet it's 1 or 2%.
Yeah, and that's high. That's high.
Yeah, I just
look at the industry. We got lots to do.
Yeah, we do. But the good news, so I'll do the glass half full. It is much easier to do in the private context than in the public context. You have many more smaller companies. You have many more entrepreneurial opportunities. And so I'm hopeful that that is the avenue that yields faster results than on the public side.
Thank you.
To Mario, to dig a little deeper in Mrs. Oliveira's question. So if in order to, everybody seems to be on the same side of trying to reach these goals of providing more minorities to access to capital, but as you know, and most of us know, that when you look at the results, it's not occurring. So what if there were a requirement by your firm or the big general partners that is going to raise a large fund, that there's a requirement to have a minority or a woman-owned firm participate, like the Rooney Rule? You know, you have to come along, and I mean, they have to be performing companies, but it's required that they participate in that particular deal.
Yeah, look, I mean, I think there are a number of ways. That's one approach. Another approach, remember, this is for better or worse, because I think part of what you want is not just portfolio companies that are minority owned. I think that is an element, certainly. But I think what you want is an industry of general partners that are minority. And this is an apprenticeship business, better or worse. And so, for example, for us, one of our real focus points is getting a more diverse general partner group, because bluntly, where a lot of general partners come from is spinning out of firms or leaving firms. They create relationships with limited partners and they go start their own firm. And if you don't have this group of minority candidates who have gotten that experience and then move off, it's very hard to have a self-sustaining group of managers that you're going to be investing with. So I think it's both elements. As I said, I think that is where you can be very impactful on holding general partners and people like us feet to the fire around, no, you need more diversity at your firm, because you're developing this talent pool that will then, it's an ecosystem, and that's what you're trying to create, and that's what you're trying to enhance.
Okay, thank you. Okay, Greg, I don't have any more questions from the board at this time.
Okay. Well, we've largely covered many of, or almost all of the questions I had sketched out. I want to thank the board for the active participation. You beat me to the punch on a number of the questions, and certainly added a number of questions even beyond what I had that I think made for a much better discussion. Just one in closing, Mario, that I'd like to ask you. It's something we've discussed a fair bit at the board level, but I'm interested in from your vantage point, how various capital allocators think about measuring their success. You kind of hit on this a bit with looking at returns as well as other factors. We've had a number of discussions of benchmarks, but I'm just interested in some of the methods you've seen and any thoughts you have around that for us.
Yeah, look, as you know, I mean, again, I'm supposed to say how wonderful an asset class it is, and it is. I totally defend it, but fees are crazy and performance is difficult to benchmark, and so I think that is something we all struggle with. Most investors look at their decision to invest in private equity as it's either public equity or private equity, and so I want private equity plus public equity plus some premium. It could be 100, it could be 300. People have different premiums on it. Most investors at this point also use, and I don't want to get technical, but a PME, which is basically saying the cash flow, every time a cash flow goes in, I invest in the stock market. When it comes out, I sell, so that you're matching cash flows, private equity versus the public market. So you can see whether it made sense to be investing in private equity. And then what benchmark you use depends. It used to only be the S&P or one of the Russell indices, but now as portfolios become more global, a lot of people use the MSCI, particularly outside, obviously, the US. So that is normally what we see, but what we then see is sometimes people will then also benchmark them against other private market indices just to see. It may look great against the public markets, but I'm underperforming private equity in general. So it's a combination. But very few investors do anything other than benchmark against a public index and some kind of premium.
Okay. Is that it, Greg, from your part? Oh,
yes,
okay. Well, thank you. We do have I know one person in the queue for public comment. And so to the public, if there are any other members of the public who wish to make comments, I would suggest you make sure you call in to the screener now so that you could be on the list. So with that, I will call on Mr. Fox to identify the person in the queue. Yeah, we have one, I think.
Yes, Mr. Chair, we have Alyssa Giacchino from the Private Equity Stakeholder Project.
Okay.
Hello, good afternoon.
Good
Can you all hear me?
Yes.
Yes, we can.
Thank you so much for the opportunity to speak. I am Alyssa Giacchino with the Private Equity Stakeholder Project. I really appreciate this discussion and particularly the good questions from the board members on human capital management, ESG, and fees in the private equity arena. I'd like to offer a counterexample to the idea that private equity is more focused on operations and value creation rather than asset stripping. The case in point here is Leonard Green and Partners, for whom CalPERS is one of its largest investors. Leonard Green owns safety net hospital chain Prospect Medical Holdings through Green Equity Investors Fund 5, which CalPERS is in, which has hospitals in Southern California and several other states. You may recall that last month you heard from two nurses represented by AFT who expressed concerns about conditions in their Prospect-owned hospitals in Connecticut. Safety net hospitals like Prospect serve some of society's most vulnerable patients. Protecting these hospitals is even more urgent during this pandemic. Instead, Leonard Green and other owners have drawn $658 million in fees and dividends from the company, even as its hospitals have suffered operating challenges, underfunded pensions, and regulatory scrutiny. Members of Congress, led by California Representative Katie Porter, have now sent 2 letters to Leonard Green detailing numerous problems with Prospect, and asking the firm to return the fees and dividends, calling Leonard Green's actions, quote, unacceptable and dishonest, unquote. From the Congress member's July 6th letter, quote, let us be clear. It is not appropriate for private equity firms to generate returns for their investors by extracting hundreds of millions of dollars from safety net hospitals, regardless of who those investors are. Having pension funds as investors does not justify Leonard Green taking critical funds from safety net hospitals and the pension funds of their healthcare workers, unquote. After 10 years of Leonard Green's ownership, Prospect's hospitals have some of the lowest quality ratings from the Centers for Medicare and Medicaid Services. Connecticut regulators placed Prospect's hospitals under review last year for deteriorating conditions that place patients in immediate jeopardy. In Rhode Island, hospital pensioners are suing Prospect for allegedly trying to shield its own liability for their pension from regulators. Prospect's owners collected the largest dividend of $457 million after committing to Rhode Island regulators that Prospect would not pay any more dividends. Last year, at the end of 2019, Prospect shut down all of its facilities in San Antonio, laying off nearly 1,000 workers, and sold its hospital building to a hotel developer. As you know, San Antonio is now facing a surge of COVID-19 hospitalizations. Now, Leonard Green is trying to quietly walk away from Prospect and sell its stake to the minority owners for a nominal sum. Leonard Green's disregard for its commitments to these hospitals cannot continue. CalPERS beneficiaries likely utilize Prospect's hospitals here in California and should not have the quality of their care threatened by looting of this safety net hospital system. We believe Leonard Green should return the fees and dividends it collected from Prospect Medical to ensure the hospitals and healthcare professionals have as many resources as possible to respond to the COVID-19 pandemic. Thank you very much for your time.
Okay, thank you very much for your comments. Okay, we will now take a break for lunch, and we will reconvene after lunch at 1:45. See y'all and have a good lunch.